All right, thank you so much for joining me. This is Gurpal Singh from Gursur Education, and as you all know that we have been doing the series regarding business environment and international business. In these days, we have covered a lot of topics, and recently we have covered the topics regarding foreign exchange, in which I have taught you regarding FERA, that was Foreign Exchange Regulation Act, and FEMA, that was Foreign Exchange Management Act. And most importantly, we have already covered the topics regarding the calculation of exchange rate, in which I have taught you the foreign exchange rate theories as well. So in this video lecture, what we are going to cover right now in this video, this is going to be regarding derivatives. Okay, so these are the most important tools for managing our foreign exchange risk. Okay, so when we talk about management of foreign exchange risk or any kind of risk arising out of import and exports, then how can we leave the topic of derivatives? Then obviously now we are going to cover about these. I shall be telling you in detail regarding the different aspects and elements of derivatives. Okay, the first we shall be talking about forward contracts, then futures, then we shall be talking about options, and finally the swaps. I shall be teaching you in detail with examples, and I'm sure that you will be enjoying this video lecture a lot. After completion of this video lecture, you shall be able to understand what do we mean by derivatives and what are different instruments of these. And still, in case you need further knowledge, we can make any kind of conversation anytime, but till right now we are going to cover all the topics necessary from the point of view of our examination. Just going to share the screen with you. I hope you'd enjoy this video lecture. See and enjoy. So we are going to talk about these techniques. Okay, foreign exchange risk management techniques. We are going to talk about these, and specifically the forward contracts, future option, and swaps. These things we are going to talk about right now. And I must tell you, these are very important because I think, again, we have planned that after this these specific subjects, like currently we are studying the business environment and international business, and after the completion of these specific topics, we shall move with the financial management, because this is very high scoring. It shall make you very worthy for solving the questions at the time of examination. And in case of financial management as well, you have to study regarding the derivatives. So it is very beneficial for us to cover a specific lecture which can be helpful in both the subjects. So now I'm going to talk about derivative contracts. Okay, derivative contracts. So these are the contract. First of all, let me give you its brief introduction, because they are not going to ask specifically about these, but the question, if the question is asked, it should be concerned about these things only. So what is derivative? Derivatives is not actually the contract in itself. It is the derived contract. It is the derived contract. Derived contract means a contract from a contract. Okay, a contract from another contract. So when we talk about this, a contract from another contract, so all these things falls under the category of a derivative. Very simple example. Okay, if you are exchanging your cash flows with someone other, this is the system of a swap. We shall be telling about this when it's time come. I'm just going to give you a simple example of a derivative. When you try, there are two persons, A and B. A tries to exchange its cash flow of any kind with B, and B tries to exchange its cash flow in consideration with A. And these cash flows are arising out of some another contracts, maybe A and B both have taken some kind of loans from some banks. Okay, so in those loans, the A has to pay interest and B has to pay interest, obviously. And if they are exchanging their interest, and if they are making the contract of exchanging their interests, then this is known as a derivative contract. Why? Because this was not actually the contract. This contract emerged from some other contract, and that contract is of actual loan. So this is how derivative works. So derivative, what does derivative mean? Derivative simply is a contract from another contract. When you shall try to understand these things, when I shall teach you these, then all the topics shall again be very clear to you, and I am very confident about that, because we have taught these things a lot of time in a university, in colleges, and the other things as well. So these are the four major options, okay, so by which you can reduce your risk in case of a financial exchange, foreign exchange management. Okay, so what are these kind of risks? I'm going to tell you about the brief description of risks first of all. So what are these? Just try to understand it deeply. Okay, when you import, okay, suppose you have imported on 1st of January 2021, you have imported some goods of worth uh, worth 1 lakh, okay, worth 1 lakh rupee, okay. So now suppose I'm just taking a very hypothetical example, okay, just taking a very hypothetical example, that at that time there was the exchange rate of $1 was, I'm just taking, okay, hypothetical, $1 was equal to 100 rupee. If we are taking this example, you have imported goods worth this rupee, worth these, okay, 1 lakh, but you are not in a position to make the payment right now, and you try to convince your supplier that you shall be making the payment after 3 months, that is on 31st of March 2021. You are going to make the payment at that date, okay, but this is very obvious. On the basis of demand and supply, if the exchange rates are determined, then it's very obvious that the exchange rate which is prevalent today, this is $1 is equal to 100 rupee. This may not be the situation at 31st of March 2021. Maybe it can rise, maybe it can come down. If this is rising, suppose it comes to 110, then obviously you shall have to pay 1,10,000, and there shall be the loss of 10,000 to you because of the increased exchange rate. And if this comes down, suppose it comes to 90, then maybe you have to pay 90,000 rupee only, then there will be the gain of 10,000 rupee to you. And this all happens just because of the contemporary and fluctuable nature of the exchange rate, because that is determined on the basis of demand and supply. Then obviously in any kind of foreign exchange deal, you are always at risk. Okay, because if there are gain, then obviously you shall be gaining, you shall be very happy, but you never know that you will be at gaining position. So this is always at risk, okay. You are always at risk for making any kind of deal to the foreign, because in more than 90% of the deals, the payment is not made immediately. Only the down payment is made, the other payment are made by making some kind of a contractual agreement, okay, at some specified future dates. So all the parties are always at risk. So how do they manage risk? They manage risk by indulging in four kind of different contracts. The first is a forward contract, the second is future contract, the third is options, the fourth one is swaps, okay. One by one I am going to teach you about all these things. So I hope you have got the idea regarding this specific example. If you have understood this example, understanding all these four categories is going to be very easy for you right now. Just going to share you one by one, okay. So the very first is a forward contract, okay. So what happens there? First of all, giving you the example of that, and after that I shall be reading what is written over there. So suppose in the same example, you have to make payment of 1 lakh rupee to some other parties. So there is a buyer, there is a seller, and the buyer is from the buyer is from India, and the seller is from America. The exporter is from America. Then what you have to do? You just meet this person personally. You just meet this person personally over the counter. Over the counter means you both of you are sitting at a specific table, and you are having some contracts with you, contractual paper, and you are just requesting this person by writing in the contract that I shall be making the payment to you after 3 months, but I shall be giving you the payment on the basis of the exchange rate which is prevalent right now. Right now means 1st of January 2021. This is known as forward contract. So I hope you have got the idea. Okay, so when you meet parties personally over the counter, okay, so what happens that you just make some kind of a contract that I am going to purchase goods worth 1 lakh right now, but I shall be making the payment after 3 months or any time stipulated written in the contract letter. So I shall be making the payment in some future date, but I shall be making payment on the basis of exchange rate which is prevalent today only, not at the exchange rate which shall be prevalent at the time when I shall be making payment. Okay, so these kind of contracts are known as a forward contract, and in this case your risk becomes zero because you have made already ready-made contract, that is a forward contract. And why this contract's name is forward contract? The only reason being that you have made the contract right now that you shall be exercising at some future date. This is why it's named as forward contract. So this is simply a customized contract between two parties to buy or sell an asset at a certain time in future for a certain price. Certain price. Okay, just read this again. Certain price that is decided today. Unlike future contracts, they are not traded in exchange, rather traded on over the counter market. Over the counter market means you meet the people personally for making the contract. Usually it happens between two financial institution or between a financial institution and one of its client or with any parties. Okay, these are known as a forward contract, and this is the very best way for indulging in the activities which reduce your risk to the level of zero. And I must tell you, nowadays these contracts are very rarely used because nowadays there are so many other contracts and derivative options are available. For example, the mostly used are futures, then options, and then swaps. One by one we shall be talking about these right now. The next are futures contract. These are traded on exchange. Okay, these are traded on exchange. So what does these do? So you just try to indulge into a contract to purchase some specific commodity at a specific rate at in future. Okay, so suppose this is 1st of January 2021, and there is an exchange, like we are taking the example of National Stock Exchange, and it offers a wide variety of futures contract. Okay, futures are the part of a derivative contract, and I must suggest you just visit the website of NSE after the completion of this lecture. Then just write any kind of option contract on the given search option, then you shall be finding its complete detail. Okay, so there are futures which you wish to purchase right now. So futures gives you option to buy or sell a certain commodity, certain commodity in future at certain price which is decided today. So this is the best option. Okay, so what do? You just purchase a contract. Which offers you to buy or sell a commodity in future at certain price which is decided today. So future contracts are forward contract traded only on organized exchanges. Organized exchanges here means NSE or BSE, and these are in standardized contract size. The investor protects himself against risk by selling a rise future or any kind of, this is just one example, they can just protect himself again a risk by selling any futures, and this action is called short hedge. And when you purchase the future contracts, this is known as long hedge. Okay, so you just have to purchase the contract. Okay, maybe you are purchasing the contract for buying some commodity at some specific date in future for a certain prices, that shall be known as long position or long hedge. Okay, and if you are buying the selling contract, that you wish to sell some certain commodity at some future date at a certain price which is going to be decided today, this is known as a put, this is known as a short position or short hedge. So these are the two kind of positions under the futures contract. I hope you have got the idea of this. So the most important thing in futures contract, you have to understand it's a features. Okay, features are very important. So the first is, these are like commodity futures. These are contracts to buy or sell financial aspects at future date at a specified price. Written this again, right? Read this again, a specified price. This is decided today. The following features are there for future contract. The first is, this is always traded on an organized future exchange. For example, NSE and BSE. The second is, these are standardized contract. You have to purchase the commodity or the future contracts in lots, like lots of 100, lots of 800, lots of 500. If you wishes to purchase some specific shares of the country, you cannot say that I wish to purchase 75 shares of Pyramid Enterprise Limited at specific price on a future date. You have to purchase those many shares which are being offered by the exchange only, and these shares are always offered in a lots. Like you can purchase a lot of 1000, lot of 500, a lot of 300, whatever the lot is specified by the exchange. This is why it is said that the future contracts are always standardized contracts. And after that, margin money is always required to be deposited to the buyer or seller in forms of secure cash or securities. So it's very obvious that you need a broker for making the contracts of a future market and in derivative context. So that broker has opened your demat account, and under this demat account there is a trading account as well. Okay, so in this trading account you always need to have margin money, only then you can purchase the contract. You must need margin money, okay. So this is known as margin money required to be deposited to the buyer or seller. And lastly, this is the system of mark to market on the daily basis. If you gain, then profit shall be shared with you. If you gain, then the profits shall be delivered to your account, and if you lose, then these shall be deducted from your account balance. So this is how it works. Okay, and how does all the clearing happens? This is done by a specific house known as clearing houses. So that was, I think that was regarding all the theoretical portion. I am just going to give you one example. Likewise, I have given the example of a forward contract. Then you shall be able to understand it further. Okay. Suppose you wishes today's rate of the dollar is 70 rupee. Okay, you have to make payment to a specific party for suppose some 7 lakh rupees. Okay, some 7 lakh rupees, but you fear that the prices may rise, the exchange rate may rise, that it is 70 today, it can be 72 or it can be 75. Then at that time you shall have to make further payment like 7,20,000. There shall be loss of 20,000. What you do, you just purchase the futures of the dollar. How do you purchase? You just need to open a demat account. After that demat account, one more account shall be given to you, that is known as a trading account. In that trading account, you have to deposit a margin money, and after you have deposited the margin money, then you shall be given the option to purchase the futures of the dollar, and they futures are listed, these futures are listed on the exchange, or the organized exchange like NSE, BSE, or foreign exchange market. So these are listed on that, okay, and you purchase that, and you purchase a contract for some certain rupee, and that can be for a very marginal money, okay, that can be for just 500 or 1000, or it can be in between that. It's not this much difficult. People feel that this is very difficult to make the investment, but being the people who have already made the investment, I can make you the suggestion that it's very easy to make, okay. So you just need margin money. When you have the margin money, you just purchase their contract. What happens, the dollar price is 70 today, okay. Suppose it rises to 71, but you have placed the bid that after 3 months you shall be making the payment only on the basis of a 70. But now the price is on in the next day the price is 71. That means there is the addition of 1 rupee that shall be known to be your gain, and at the end of the day that shall be credited to your account. And in the same way, suppose the prices comes down to 68 rupee, okay, it comes down to 68 rupee. Still, when you have already purchased the contract, future contract, you have to pay, uh, you have to pay prices on the basis of a 70 rupee. That means you shall be losing 2 rupee, and that 2 rupees shall be debited from your account, trading account, okay. So debiting and crediting happens on a daily basis, and this debiting and crediting is known as margin to money, okay, marked to market, marked to market, okay. That term was used here, okay, that was used here. So marked to market is a system what you which you have to understand, okay. So at the end of the 3 months, for all the 90 days, the gains shall be credited, the losses shall be debited. And when you shall try to calculate the final position of yourself, you shall get to know that by adding all the gains and by reducing all the losses, your final position is still 70 rupee. And this is a magic. I must tell you, try to do that. Try to solve this in your copy. You shall get to know that the last position shall be 70 rupee. Just by purchasing a future contract for just a very meager amount, you can indulge into the kind of a contract which shall give you the final position at specified future date at a specific price which you have determined today. So I hope you have got the idea of this, okay. I'm not going to go very deep in that because this topic is very deep. I'm doing the research on this field. So in case anyone in future is interested for these kind of things, then we can take another lecture or some other consultations as well. So I hope you have got the idea regarding future market. There are some players in the future market. Now I'm just going soon, okay, because I hope you would have already got the idea. The first players are hedgers. Hedger are the person who just purchase the option, who just purchase the future contracts just to save themselves from the risk. And how do they save themselves? I have already given you this complete example. This is the way they save themselves from the risk arising out of the fluctuations in the foreign exchange market. They are known as hedgers. The second one are speculators. These are those persons who speculate on the future prices, okay. They do not wait for 3 months longer. They just take the position whenever they feel that they are in a position of gain. Then they just come out of that contract and they just gain the relative money. So they are willing to take risk and take future position, and they expect to earn a profit in short run. So they just earn on the basis of price fluctuation. These are speculators. And the last are arbitrageurs. These are important. They try to make the money on the basis of a price differential of two markets. Suppose in the one market the dollar is being offered at 70.25. In the second market the dollar is being offered at 70.15. So this is the difference of 0.10 basis points. So they just immediately indulge into the contract of at this price, and they just take the benefit on the basis of 0.10 basis. It seems that this is a very short, but when you actually multiply this by the units the people purchase, then these are in crores. The value falls in crores. So they are known as arbitrager, who try to take the advantage of a price differentials of two markets. So I hope you have got the idea right now. So the next things are the option markets. These things we have to understand. Okay, now we are going to talk about option. I have already taught you regarding forward contracts. I have already taught you regarding futures contract. I have already taught you regarding the options market. Options, what are these? Okay, what are these? So this is the advanced, extremely advanced version of, we can say, of derivative contract. These are option markets. These also need the margin requirement, but these are extremely different from futures. Okay, these are different from futures. What do they do? The option may be defined as a contract between parties where one party gives other the right, not the obligation, to buy or sell an underlying asset at specified date within or on a specified time frame. Okay, so I hope that this was extremely longer enough. Some of you would not be able to understand. I'm going to give you an example right now. Okay, so suppose you have purchased a contract. You have purchased a contract. You have purchased a contract that you are going to buy the dollars worth 1 lakh rupee at a specified date at the exchange rate of a 70 rupee. Okay, you shall buy the you have already bought the contract that you shall buy the dollars worth 1 lakh at the exchange of a 70 rupee in future date. Okay, so you shall buy at this price. Okay, suppose in the future date the contract, the actual price or the market price comes to 72, then obviously you are at loss for 2 rupee. Okay, then what you do, you can just leave out from the contract. You can just leave out from the contract. If you feel that you are losing money, you shall just leave out of the contract. This is known as options. This is why it's known as option. Okay, option gives you right to leave out if you feel that you are losing money. I'm giving you another example. Suppose you have purchased a contract that you shall be selling some of the shares, selling 1000 shares of a certain company if the prices are 50. Okay, if the prices are 50, then you shall be selling. Okay, then you shall be selling this. Okay, then what you do, you in case the prices comes to be 55, then obviously you are you are gaining 5. You are having the gain of a 5 rupee. Then you shall exercise this. Okay, then if suppose if the prices come down to 45, then you shall sell at 50 only. Okay, then you have the option. You can anytime leave out of the contract. Okay, if you are in the money, because there in the option contract there are three situations actually. These are the situations of in the money. So in the money is the situation when you feel that you are gaining the amount. Okay, that there is the next position out of the money when you feel that you are not gaining, rather you are losing. Okay, then the last thing is at the money when you feel that neither you are losing nor you are gaining. Okay, neither gain nor there are losses. Okay, so in the first case, the contractee or the person who has purchased the contract, he always try to exercise that, okay, exercise the contract. But in the second case when he is out of money, he just leave out of the contract, and at the end of the money, this is the just the option to him whether he can exercise or he can leave from the contract. And what does it benefit? It benefits that it need very less amount than future contracts to indulge into this kind of a contract. Now you can see, you can believe that this is a kind of a magic happens, okay, magic happens in the derivative. So now you shall be able to understand this line again. If I'm reading, option may be defined as a contract between two parties where one gives the other the right, not the obligation. Right means he can exercise or he can't exercise, that's his wish. It's not the obligation to buy or sell. He can buy the contract, he can sell the contract, an underlying asset at specified price on specified time. So when he is purchasing the contract of buy, this is known as long option, long option, okay. And when he is purchasing the contract for selling the commodity or underlying commodity, this is known as the put option, okay. When he is purchasing the contract to buy, this is known as long option or buy option. You can simply say that call option, this is the call option. And when you purchase the contract for selling underlying commodity at specified price, specified time, this is put option. So option has two kind of contracts, the call option or the put option. Call option is the contract to buy commodity and put option is the contract to sell commodity. These are just the contract, okay. You can exercise, you can't exercise at your wish. You do not have any kind of obligation. This is all about options market. I hope you have got that. So contract, this is just an option contract, okay. This is an agreement to buy, sell asset. Then premium, first of all, you have to make the margin money payment to the seller, okay, so that the party. So this is known as premium, okay. The next one is holder or writer. Holder who buys the who holds the option is the buyer. Who writes the option, he is known as a seller, okay. Holder is buyer, seller is writer. Exercise price at which it shall actually be exercised, okay. You have made the bid that you shall be purchasing the shares of the commodity at the price of 70, okay. At the price of 70 you shall be purchasing. At the price of suppose if I'm today I'm making the bid that at the price of 12 I shall be selling Yes Bank. I shall be selling Yes Bank at the price of 12, okay. So that price is known as strike price or exercise price. And whatever the price is currently into the market, like today it was 11.15 rupee, okay. So this is known as market price. So if I've made the bid that I shall be selling only at 12, now the price is this, that means I am earning 0.85, then I shall be exercising my option. So if the price rises beyond 12, like it comes to be 12.50, then I shall not be exercising. So in this way you can understand that, okay. So this is put option for a right to buy. This is the put option, right to sell the underlying asset, and this is the call option, a right to buy underlying asset, okay. So this is all about that. And then there are American and European option, okay. So American option can be exercised only or at the expiry, only at that time, okay. So American option provide the holder right to buy, sell, and expiry of the option. On the other hand, European option can be exercised only on the date when maturity is cleared. So this is the difference between these two. Once this was asked in the examination, that's why we have included. This is American option, this is European option. What's the difference between these two? Each and every contract has a delivery or maturity date, okay. So European contract or European options can be exercised only when the maturity occurs. like 31st of March 2021, like any date prescribed. But the American options can be exercised anytime within the time frame of the issuing date and the maturity date, though they can be exercised anytime. So this is the difference between these two. And next is the in the money option, when obviously when you are earning money or when you are at a gaining position. I have already given you example. You have made the bid that I shall be selling Yes Bank share at 12 rupee. So if this is 11.15 today, then I shall be selling at 12 because I am gaining 0.85 rupee. So when so this is the case of a put option. So in case I have made the bid that I shall be purchasing the Yes Bank at 12 rupee. Okay, I shall be purchasing at 12 rupees. Suppose the prices comes to 13 rupee, but I have to purchase at 12 rupee. That means I am gaining 1 rupee. Then I shall be exercising my contract. And if the price comes down to 11 rupee, then obviously I shall be at loss at 1 rupee. Then I shall not exercise my contract. So this is known as in the money position. Out of the money, when obviously you are losing. Okay, in case you are losing, this is known as out of the money contracts. And the last one are the at the money options, when strike price is always equal to the market price, when you are neither you are losing nor you are earning money. Okay, so neither there are losses nor there are gains. At that situation, the options are said to be at the money options. But I'm just going to give you right now the example, the best example for discriminating between in the money option. The first is going to be in the money option, the last is out of the money, and the second is out of the money option, the last is at the money option. Why I'm going to give you this example? We have already covered a lot, whatever was sufficient, but 3 or 4 times the questions was somewhat very tricky, and I am just going to tell you, explain the concept of these all in a way that these shall become very easy for you right now. So we have talked about two things. Okay, the first one is call option. Call option, when you purchase the contract to buy a certain underlying asset, certain commodity. Okay, these can be shares or anything. And we have already talked about put option as well, and that is the option to sell the underlying asset. These can be shares. Okay, so this is, I'm going to give you a very obvious example. Okay, when you have taken the call option at the price of 12 rupee. I'm giving you my example right now. Okay, Yes Bank is around 11:15 today. Okay, it was 11:15 today. I was just watching the market because this is my daily routine. So Yes Bank is at this. If I am just placing this, although this is now not in the derivatives options right now, because options are not given for this specific script. So today's the price. If I am just placing, I'm just placing the order that I shall be purchasing the Yes Bank stocks at 11 rupee. At 11 rupee, I am just bidding for this price. Then this price shall be known to be my strike price. Strike price. This is known as a strike price. I hope you got the idea of what strike price is, at which you purchase the contract. Actually, this is known as strike price. Okay, so now what happens is, suppose so I have made the bid that I shall be buying the shares of Yes Bank at the rate of 11 rupee. So today the price is 11.50 rupee, and the price which is prevalent today, that is known as market price. Okay, this is known as market price. So what happens in this case? Strike price is lesser than market price. When strike price is lesser than market price and you have bought a call option, then you are obviously at losing position. Okay, I have made the bid for this. Okay, so in this case, you can just take this example. So I have made the bid that I shall be purchasing the share of Yes Bank at 11 rupee. This is my final bid. So sorry, you are not at loss. I'm giving you further example. So you have made the bid that I shall be purchasing the shares of Yes Bank at 11 rupee. But today the prices is this. But you have made the bid for 11 rupee. That means you are, if you are exercising the contract right now, then you shall be given option to purchase the shares at 11 rupee. Although the market price is 11.15, that means you are earning 0.15 rupee. What does conclusion it make? It just makes the conclusion that if this strike price, which is 11, if this is lesser than the market price, then at this situation you are gaining the money. And when you are gaining the money, this is known as uh, in the money options. These are known as in the money options. These are known as in the money option. And in the same way, suppose the price comes down to a 10.85 rupee, 10.85 rupee. Okay, suppose price comes down to this, that is the new market price. Okay, so what happens then? Obviously I made the bid that I shall be purchasing at 11 rupee, but the market price is down now. Then obviously I shall not exercise my contract. I shall just leave out of the contract because I'm losing money. Then what conclusion can you make? You can simply make the conclusion that if the strike price is greater than market price and the options are call options, then in that case you are losing the money. And when you are losing money, this situation is known as out of the money situation. Out of the money situation, this is that situation. And in case suppose I have made the bid for purchasing the shares of Yes Bank at 11 rupee, and consequently, or suppose the market price also comes to be 11 rupee today. So these are both equal. When strike price is equal to market price, that is the situation of at the money options, in which you are neither losing nor earning anything. So I hope now you have got the idea. And if you have got the idea regarding call option, that then you can reverse all these position in case of a put options. Then you can easily understand that as well. I'm just going to give example of this as well. Okay. So there are put options. What is put options? Put option simply means you have placed a bid to sell some shares at specified price. Suppose I have made the bid that I shall be selling my holdings for Yes Bank at the rate of 12 rupee. Okay, so this is my strike price, at the price at which I have purchased the contract. Okay, I have given a premium and I have taken the contract that I shall be selling my holdings of Yes Bank at the rate of 12 rupee. Okay, at the rate of 12 rupee I shall be selling. Just listen it so many times. Suppose the prices comes to 11.85. This is known as market price. Okay, but I have placed the bid that I shall be selling at 12 rupee only. Okay, so the market price is this. Then at that position, although the market price is this, but I shall be selling at 12 rupee. This is that I am gaining 0.15 rupee if I exercise this contract. Okay, so what conclusion can you make? You can simply make the conclusion, if strike price is greater than market price and the contract is of a put option, then you are gaining the money. And if you are gaining the money, then obviously you are at the situation of in the money. You are at the situation of in the money. In the same way, suppose the prices comes to 12.50. You had placed the bid that I shall be selling my holding at 12 rupee, but now the prices is 12.50 and this is the market price. Then what happens? Then you had purchased the contract, but you shall not exercise. You shall just leave out of that, because if you are selling your holdings at 12 rupee, then you shall be losing 0.50. Then what conclusion can you draw? You can simply draw, if strike price is lesser than market price and the contract is of a put option, then you are losing the money. And if you are losing the money, this is the situation of out of the money. So this is how you should understand these things. And again, if the strike price is equal to market price, this is the situation of add the money options. So I hope in detailed I have taught you so much. You shall not get these kind of detailed anywhere, I must tell you. Still, this is a very larger topic. Okay, so this is very interesting as well. In case if you wish to pursue further research or any kind of things, then we shall be talking about that. So just going to move further, going to teach you regarding the swaps now. Okay, this is swap. Just one example. After that, we shall be moving further. So what is swap? Swap is just when you exchange your cash flows. This is known as a contract of a financial derivative. Suppose this is there are two parties, A and B. A is the resident of India, and B is the resident of Canada. Okay, he is the resident of Canada. So he has the branch. He has a branch of his company in Canada as well. In Canada, he is having the branch for his company, and B is having his branch in India. He is having branch in India, obviously. Okay. So they have the Indian company. The Indian company has taken the loan from a Canadian bank. Loan from a Canadian bank so that they can make fund available for their branch which is in Canada. And in the same way, suppose B has taken the loan from an Indian bank, so that they can give funds to their branch which is situated in India. So both of the persons are the parties who have taken the loan for their branches which are residing in each other's countries. Okay, so they have taken the loan. Then it's very obvious. If A is paying, it's very obvious, then they have taken the loan. They both of the parties have to pay the interest. Okay, interest to their respective branches, banks. So the Canadian person has to pay interest to the Indian bank, and the Indian person has to pay interest to the Canadian bank. So by transferring the money, they shall be facing a lot of transaction cost. Okay, because these are not their pay. These banks are not the banks of their residing countries, and they shall be facing number of hindrances, number of problems for making the contracts with these banks. Okay, simply what do? They meet each other. They just exchange their cash flows. How do they exchange? A tells the B that your company is in India and you have taken the loan from Indian bank. I shall pay the interest on your behalf to your bank. And what you have to do, you have to pay the interest to the Canadian bank from which we have taken the loan, and you shall take our interest liability. In the same way, they shall be exchanging their interest liability. This is known as exchange of cash flows, and this is known as a swaps market. This is all about swaps. If you have understood this one example, each and everything is cleared to you right now, I must tell you. So this is all about that. Okay, just when you exchange your cash flows in a way that your liability becomes the liability of someone else, and the someone else liability becomes the liability of yours. So this is the situation of swaps. I hope you have got the idea now. Nothing is left, only some terminologies, and these are very easy to go through. The first, there are features. Okay, there are counterparties, the person of A country and the person of B country. These are known as counterparties. The second, facilitator. It's not that these two parties know each other. Maybe they are knowing each other from a broker, from a middleman, and that middleman is known as a facilitator. Okay, this is facilitator. Cash flow is simply the cash flow. Okay, they are exchanging. It can be interest, it can be principal amount, it can be some other cash flow. I have given you only one example. Cash flow can be of any types. Then this is less documentation. In swap contract, there is less documentation is needed. Only one contract between the two counterparties is needed, and everything is done within lesser cost. After that, transaction cost become very less for both of the parties, and both of the parties are in the position of gains. Then it benefits to both the party. I have already explained this to you. Okay. Then the next one is default risk. It's very less. In case of swaps, default risk is higher in a relation to options and future. How this is higher? This is very obvious. This is person A, this is person B. It's very obvious that one party can default at any time. Even the contract is written, maybe that the one party becomes bankrupt, and if it becomes bankrupt, then what happens? Then they shall not be able to deliver you. They shall not be able to deliver you the required money. So in this way, you can say that the default risk is higher in case of swaps, because at any time any party can make a default. If it becomes bankrupt, then how you shall get your money? You are paying money on his behalf. So this is, but this is a very rare case, because the person, the counterparty you find is always very financially sound. So I think this is all about that. I have taught you a lot in today's lectures. Okay, this is going to be the third lecture. I think it's not much of the time. We shall be able to cover two basic topics more, and after that we shall be seeing what is there for us. So I have taught you right now regarding foreign exchange theories, and a derivative market as well. Now I'm going to tell you, if you wish to make investment outside India, how you can do. You have 2 or 3 options. Okay, 2 options basically. The first are American depository receipts. These are ADR. Then the second one is global depository receipts. These are GDRs. Okay, what are these and how do they work? I'm going to tell you right now. Only some description is needed. Everything is already given there, but I shall be clearing your concepts. What are these? What are depository receipts? First of all, I'm going to tell you. Okay, if you purchase the shares of the companies which are listed in NSE and BSE, which are the exchanges of your own company, then you shall be issued the shares in the form of dematerialized format. Okay, in your demat account, these shall be shown. But in case you wish to purchase the share of a company which is not listed in the stock exchange of your country, but this is listed in the stock exchange of some other country, then you shall not get the shares in dematerialized form. You shall get a certificate which shall be known as a depository receipt. So I hope you have got some idea right now. Depository receipts are types of negotiable financial security representing a security usually in the form of equity issued by a foreign publicly listed company. So this is what DR is about. Okay, so this is of 2 type. Okay, so the first is American depository receipt and the second is global depository receipts. The American depository receipt, as the name suggests, these are those receipts which are issued to you if you purchase the shares of the company which is listed in the United States. Okay, so these were popularly known as ADR, and they were introduced in 1927. ADR securities issued by the company which is traded on the United Stock exchanges. Okay, which is listed on the stock exchanges of United States. If that company is like Apple, okay, for example, that. Okay, so if these kind of companies are listed in the American stock exchanges, then if you are purchasing their shares, then whatever the security certificate you shall get, that shall be termed as American depository receipt. And except America, if you purchase securities listed in any country, in the stock exchange of any country except America, then whatever the receipts you will be getting, these shall be known as global depository receipt. And the first issue was made in 1990 with that. Okay, so these are listed on exchanges outside the United States, like Luxembourg or London or any stock exchange like that. So I think this is all about that. IDR you all already know. Okay, so this is just the depository receipt. I've already taught you that whenever you purchase the share, like I have already made the investment in some of the company, I have already come out of these in these these receipts some days ago. Some new IPOs were launched. I have suggested it to so many person that was opened at 175%. Okay, so you can imagine how much the people would have earned. Okay, so whatever in the form, the dematerialized form, you get your share. These are known as Indian depository receipt, and you can just withdraw these at any time. So these are all about that. I hope I have taught you a lot in this video lecture. You would have enjoyed that. If the next lecture is taken, because I know that it would be very typical for you for sitting and listening and understanding these all, because I have taught a lot, but I'm literally enjoying very much. Maybe we shall be talking a lot of lectures. If next lecture is taken, we shall be informing you for sure. Thank you so much for joining me. This is Gurpal Singh from Gursur Education.